A massive 900-page bill just passed that will completely change how much money seniors keep in their pockets. And most people have no idea what's coming. In the next 10 minutes, I'm going to break down exactly how this new legislation affects your taxes, Medicare costs, and Social Security benefits. Whether you're already retired, approaching 65, or helping elderly parents, these changes will directly impact your finances starting as early as next year. Stay until the end because I'll show you the specific steps you need to take right now to maximize these benefits and avoid potential pitfalls. Welcome to Financial Area, where we cut through the complexity to bring you clear, actionable financial insights. If this kind of content helps you make better money decisions, smash that like button and subscribe for more videos that protect and grow your wealth. Let's start with the biggest change that could put thousands of dollars back in your pocket. If you're 65 or older, this legislation introduces something called the senior tax deduction, and it's worth an additional $6,000 on top of your standard deduction. For married couples where both spouses are over 65, that's a combined $12,000 deduction. Now, here's what this actually means for your wallet. Let's say you're single and in the 22% tax bracket. That $6,000 deduction could save you over $1,300 in taxes. If you're married filing jointly in the same bracket, that $12,000 deduction could mean $2,640 less in taxes. This isn't pocket change. This is real money that stays in your bank account instead of going to the IRS. But here's the critical part. This is a deduction, not a credit. A credit reduces your tax bill dollar for dollar, while a deduction reduces your taxable income. So the actual savings depend on your tax bracket. But for most seniors, this is still substantial relief. The qualification rules are straightforward but important. If your income is below $75,000 as a single filer or $150,000 if you're married filing jointly, you get the full deduction. Above these thresholds, the deduction phases out using a 6% reduction formula. There's no hard cutoff, but higher earners will see the benefit shrink significantly. Here's the good news. You don't need to do anything special to get this deduction. It's applied automatically if you meet the age and income criteria. Your tax software or accountant will handle it. However, and this is crucial, this deduction is set to expire after 2028 unless Congress extends it. So we're looking at a temporary benefit that could disappear in just a few years. Now, many seniors were hoping this bill would eliminate federal taxes on Social Security benefits entirely. Unfortunately, that didn't happen. The new $6,000 deduction doesn't change how Social Security is taxed, because it doesn't reduce your adjusted gross income. Up to 85% of your Social Security benefits can still be taxable, depending on your other income like pensions, IRA withdrawals, and interest. The IRS's provisional income formula remains exactly the same. This is a common misconception I want to clear up. While the senior deduction may lower your overall tax bill, it doesn't alter the fundamental calculation for Social Security taxation. Your monthly Social Security payment also remains unchanged. These are strictly changes to how the IRS treats your benefits at tax time. Moving on to healthcare costs, this legislation brings some genuinely game-changing news for prescription drugs. Starting in 2026, Medicare Part D enrollees will have a hard cap of $2,000 per year on out-of-pocket prescription drug costs. Once you hit this cap, you pay nothing more for covered medications, regardless of their total cost. This is massive for seniors dealing with expensive medications. Right now, if you're on costly drugs like cancer treatments, insulin, or specialty inhalers, your out-of-pocket costs can spiral into the tens of thousands. With this new cap, your maximum exposure is $2,000 per year, period. The cap applies specifically to outpatient prescription drugs, the ones you pick up at the pharmacy. It doesn't cover drugs administered in hospitals or under Medicare Part B. But for most seniors, this covers the bulk of their prescription costs. The bill also introduces smoother pay, meant options. Instead of paying large sums early in the year when you're working through your deductible, you can spread out your out-of-pocket costs over the entire year. This installment plan approach can help with budgeting and reduce the financial stress of expensive medications. Additionally, Medicare will have greater authority to negotiate drug prices directly with manufacturers, covering more drugs and doing so more quickly. The goal is to lower prices across the board and make costs more predictable for everyone. But while Medicare gets some positive changes, Medicaid faces tighter restrictions that could affect long-term care planning. The bill proposes recalculating the home equity limit for Medicaid eligibility, potentially lowering it or freezing future increases. Since Medicaid is the primary payer for long-term nursing home care in the United States, this could make it harder for middle-class seniors to qualify for coverage. If you own a home, stricter rules may require you to spend down assets, consider reverse mortgages, or restructure ownership to meet eligibility requirements. This is particularly concerning for seniors who want to preserve their home for their spouse or pass it on to children. The bill also requires states to redetermine Medicaid eligibility more often and with stricter oversight. This could lead to loss of coverage if paperwork is incomplete or deadlines are missed. For older adults who aren't tech-savvy or lack family support, this creates additional risk of losing essential health care coverage. There's also a concerning change to provider taxes. The bill tightens rules on how states can tax health care providers to fund Medicaid. If states can't raise enough money through these taxes, it could lead to fewer services, tighter eligibility, or lower payments to nursing homes and home care providers. Speaking of complications, the bill introduces much stricter identity verification requirements for Social Security, Medicare, and Medicaid. To combat fraud, these new requirements may include biometric scans, two-factor authentication, and document uploads via online portals. While fraud protection is important, these changes create significant challenges for seniors. Many older adults lack smartphones, reliable internet access, or comfort with digital tools. Those who rely on in-person visits or help from caregivers may face delays or interruptions in accessing their benefits. There are also legitimate data privacy concerns, as more personal information is required to be stored and transmitted online. People who manage benefits for others will also face stricter verification, adding paperwork and potential delays to an already complex process. Now, here's something that could affect Medicare in ways most people don't understand. It's called the PayGo rule. PayGo stands for pay as you go, and it's a budget rule requiring new government spending or tax cuts to be offset by raising revenue or cutting spending elsewhere. If the math doesn't add up, automatic cuts kick in. If this bill increases the deficit and isn't offset by other measures, Medicare provider payments could be cut. This doesn't mean your benefits disappear, but it could lead to fewer doctors accepting Medicare or reduced services as healthcare providers receive lower reimbursement rates. Congress often waives PayGo rules for major bills, but this legislation doesn't automatically do so. Unless Congress acts separately, Medicare could face these cuts as early as next year. This is completely separate from the Social Security Trust Fund issue, but it's another layer of complexity that could affect your healthcare access. On a more positive note, the bill enhances retirement savings opportunities through the Savers Credit. This credit increases from a maximum of $2,000 to $2,100 starting in 2027. The Savers Credit is actually a tax credit, not a deduction, which means it reduces your tax bill dollar for dollar. The credit is available for low and middle-income earners who contribute to retirement accounts like IRAs or 401ks. If you contribute $1,000 and qualify for the 50% credit, you get $500 off your tax bill. The bill also expands eligible contributions to include ABLE accounts for individuals with disabilities. This credit is significantly underused, often because people don't know about it or assume they don't qualify. If you're still working in your 50s or 60s, or if you're helping a disabled dependent, this could provide meaningful tax savings while encouraging retirement security. So what should you do with all this information? Let me give you a practical action plan you can start implementing immediately. First, review your tax situation. Check if you qualify for the new senior deduction and make sure you understand how it affects your overall tax picture. If you use tax software, it should automatic. Ally apply the deduction, but if you work with an accountant, mention it specifically. Don't assume they're up to date on every provision of this massive bill. Second, prepare for the Medicare changes. If you're on Medicare Part D, start tracking your prescription drug spending now. Ask your pharmacist or plan provider about the new $2,000 cap and payment options. Understanding your current costs will help you budget for the changes coming in 2026. Third, if you're on Medicaid or think you might need long-term care in the future. Stay on top of paperwork and deadlines. The eligibility checks are becoming more frequent and stringent. Seek help from advocates or social workers if you're unsure about how the changes affect your specific situation. Fourth, get ready for digital verification. Set up online accounts for Social Security and Medicare now before the new requirements take effect. Update your contact information and passwords. If you're uncomfortable with technology, ask a trusted family member or friend to help you, or reach out to your local senior center for assistance. Fifth, if you're still working, maximize your retirement savings and check your eligibility for the Enhanced Savers Credit. Even small contributions can result in meaningful tax savings, and if you support a disabled dependent, look into ABLE accounts as well. Finally, stay informed and engaged. These changes underscore the importance of understanding your benefits and planning ahead. Many of these provisions are temporary or subject to future political decisions. Follow updates from trusted sources, and don't hesitate to contact your representatives if you have concerns about PayGo rules or other provisions that could affect your benefits. This legislation brings both opportunities and challenges for seniors. The tax deduction and Medicare drug cap offer real financial relief, but the Medicaid changes and digital verification requirements create new complexities. By staying proactive and informed, you can maximize the benefits while preparing for the potential complications. Remember, most of these changes will be applied automatically, but some require action on your part. Don't wait until the last minute to set up accounts or understand new requirements. The earlier you prepare, the smoother these transitions will be. If this breakdown helped you understand how this legislation affects your finances, hit that like button and subscribe to Financial Area for more videos that help you navigate complex financial changes. Drop a comment below if you have questions about any of these provisions. I read every comment and often use them for future video topics. Thanks for watching, and I'll see you in the next video where we'll dive deeper into Medicare planning strategies for 2026 and beyond.